Good morning and welcome to Money Talks, the place where money meets politics, as we like to say. I'm Mike Hayflick of the Financial Guys. Happy to be here hosting the show and grateful to you for tuning in today. We have a lot of fun here on WGRZ every Tuesday, as we do on our radio show every Saturday from 1 to 3 p.m., and that's on WBEN 930. Each week we hope to inform, educate, and empower you, the viewer, on financial topics. We're always hoping that we can help you make informed decisions. I'd like to send our love, thoughts, and prayers to all of our fellow American citizens still dealing with the destruction and chaos caused by Hurricane Harvey. Just an awful set of events. Later in the show, I'll be talking with life insurance expert and wealth manager Charlie Sparazza, so stay tuned for that. Right now, I'm joined in studio by chartered financial analyst, wealth manager, and one of the Financial Guys' chief portfolio managers, John Thur. John, thanks for being here today.
Hi, Mike.
How are you?
Doing well, thank
Very
you.
good, good. I know what I do every day. I'm in the office, as you know, we're neighbors. I meet with lots of people. I'm usually coaching and financial planning with people, trying to help people make informed decisions on a plan. Maybe it's to get out of working years into retirement years. Maybe it's retirement years and how to harvest out of their own wealth. Tell me what a typical day is like for you.
Well, I tell people that most of the time I spend 12 hours a day in a room with no windows. I spend my time, since I manage large portfolios of individual stocks and bonds, spend my time reading articles and information on the companies I invest in.
Right.
Then I also look for new opportunities all the time. Stocks that may have value that were not on the radar last week are on the radar this week. And then finally, I spend time reading and learning about the environment, interest rates, economic information, political environment, and how that's going to affect the portfolios I manage.
Right. So everything that's scrolling across the screen on some of the certain financial stations, you're watching some of that.
Yeah, I kind of keep one eye on it. I multitask, doing a lot of reading, doing a lot of listening at the same time. If something catches my ear, I might pay closer attention to it, or I know something's coming up that I want to pay attention to, I do that. So, there's a bunch of things going on at the same time.
So it's not just fixed income and watching interest rates for those types of tools. It's also stocks, right? You have clients that are on both ends of the spectrum, and you sort of blend that stuff together for them, right?
Exactly. I do both.
Yeah.
Research and analysis on stocks and bonds, and then portfolio management and trading on both stocks and bonds.
Right. And we always joke about John in the office that he's not allowed to basically leave his office because he's the guy we go to if we wonder what's going to happen out there in the markets, what's going to happen because of a hurricane, what's happening because of North Korea and the silly things that they seem to keep doing to provoke the rest of the world. So when you see interest rates changing, what is it that a guy like me who's not tuned in every minute of the day, what should I be thinking and what should I be saying maybe to my clients about that?
Well, interest rates usually don't change that quickly. So what you have to do is you have to forecast and try to anticipate what they might be 6 months down the road. And when you're managing bond portfolios or trying to put money into fixed income for clients.
Okay.
And a big part of it right now is the Federal Reserve.
Right.
So we're watching to see what they do, and it's pretty non-traditional with what's been going on and how they're going to unwind what they've gotten themselves into with zero interest rates and easy money. So that's what I'm paying most attention to.
Right.
And they're going to open up the balance sheet, start selling things off their balance sheet, which is going to control the longer end of the curve. And Fed funds is controlling the shorter end. I think they're just going to try to maintain a steep curve and try to get Fed funds closer to 2%. Which, if you look back historically since 1950, Fed funds have traded at or above GDP. So GDP right now is running in the last few years around 2%.
Right.
So a 2% Fed fund target is not unrealistic, should not hurt the economy, but it will affect the stock and bond markets.
Right.
And then we use that to maintain our portfolios at the risk levels we need to keep them at.
Okay. Yeah, it's so impossible for even someone like me. I mean, people think, well, you're a financial advisor, Mike. Well, how do you not know this? It's impossible for one person, even maybe two in an office setting, to remember and know everything and stay tuned in. And that's one of the things I think is one of the true values of our firm, and I say it every day. We have experts, we have specialists in every little area of what people are going through, and clearly you're one of them to track the things that are going on out in the markets. I know a lot of people say, come on, I heard that the rates are rising. How come my portfolio's not there yet? So it's one of the things that I hear a lot.
Well, there's two important things in this business to simplify. It's a business of information. And the ones who can analyze and disseminate the information and weed out what's of no consequence, and understanding it's a business of probability, statistics, and reversion to the mean. And then with those two tools, you spend a lot of time on them, but those two tools help you and guide you in how to make decisions.
Right. So all the noise, all the interference that you might hear out there, folks, it's really important to know how to skim through all of that, and John is certainly someone who can help us do that. We're going to take a quick break. Please stay tuned to WGRZ. Here, Money Talks will continue in just a moment. We'll be back here with John Thur. We're back here on Money Talks. I'm Mike Hayflick, host of today's show. Folks, we really appreciate you tuning in today. I want to also mention, though, that we do manage money for a living throughout the week. If you do need us, please call us at 633-1515. You can actually meet with one or more of the many specialists in our office that take care of things from financial planning to retirement planning. Social Security claiming strategies is one thing I know I focus on. We also have people focusing on Medicare and college planning, and so much more. So please do that. And also like us on Facebook. Get our numbers up on Facebook for us. You can also follow us using @FinGuys on Twitter. And you can also check us out the old-fashioned way, I guess now, thefinancialguys.com. We've been talking to John Thur, a key part of our investment team here today. We've been talking interest rates and how that impacts investors. The Federal Reserve seems to always come out with announcements, right? Reports, announcements, in different cities even. What do you think about the actions they might take over the next 6 to 12 months that could impact just your typical investors?
Well, it's not just our central bank, it's central banks around the world have really been influential on these markets the last 6 to 8 years with the easy money policies. Now, we as the United States have led into that. Now we're leading out of it. And we're trying to unwind what we've gotten into. And I expect the Federal Reserve will make some announcements in September that they will be starting to unwind their balance sheet. What that means is they're going to either start to sell bonds out into the street. They own about $4 trillion. Or they're going to stop reinvesting the cash flows from those bonds into new bonds. And that's important. And I do believe before year end they will raise rates another 25 basis points one more time.
Okay.
I can't tell you what month, but
I'm going to ask you to play historian for a second.
Sure.
Help me and the viewers understand, how did we get into this mess where interest rates have gone so low that conservative investors really have not been able to take advantage of that, and then maybe even get into the idea of who likes low interest rates, who doesn't?
That's very complicated, but quickly, it's been going on for over 30 years. It started when rates peaked in 80, 82, and then started falling right through the 80s and 90s and helped propel the economy and the stock market. And most recently, in the last 8 years since the financial crisis, it was a need for easy money and creating liquidity because the crisis was so bad. But the problem was there was no government intervention with fiscal policies to help carry. It's the Federal Reserve that deals with the immediate problem and liquidity. It's the government that comes in with fiscal policies to ensure we get economic growth. That didn't work. There was not enough fiscal policy, and Bernanke kept talking about that. And now he had said when the costs become greater than the benefits, we have to start backing out of this. And that's what's going on, because savers are being punished, pensions are being punished because of low interest rates and low returns. Assets, stocks, real estate, even art, things of that nature have ballooned, and they're somewhat overpriced. And the Federal Reserve sees that they're part of that. So they want to get themselves out of being interjected into the market, and they want to get more of a normal level of interest rates. Like I said, if you went to 2%, that would be normal. It's not, I don't consider it, so it is a tightening, but not a direct tightening where it will hurt economic growth.
And so the 2% interest rate, though, is sort of coinciding along with the GDP growth
right now,
with other things going on in the markets.
Right, but if we get some fiscal policies in the fourth quarter, and I can't even tell you what the probabilities are, but it doesn't look good right now. But if we could get some fiscal policies with regard to health and tax and energy and some of the other important issues out there, that would help solidify and justify the Fed getting out of the way and try to increase economic growth and GDP. If that happens,
we prefer them to get out of the
well,
way.
right. If that happens, you get more hiring, more jobs, more money in the economy. I think it would put a spark and help the Fed to pull out without having as much of an impact on stocks and bonds.
Okay. It's a very complicated topic. Folks, if you'd like to reach John throughout the week, you can reach him at 633-1515. Talk fixed income, talk stocks, talk bigger issues with John. We're going to take a quick break here, and coming up next, we'll be talking to life insurance specialist and wealth manager Charlie Sparazza. Please stay tuned. Money Talks will continue in just a moment.